On the 5th of April, 2007, two analysts at Standard & Poor's were discussing a deal on their internal messaging system. One of them wrote that the deal was ridiculous. The other agreed that their model did not capture half of the risk. Then she typed the sentence that would end up in a congressional exhibit. "We rate every deal. It could be structured by cows, and we would rate it." They rated it. Most of us were taught that the 2008 financial crisis was a story about greed. Bankers who gambled, brokers who lied, families who bought houses they could not afford. And then, one morning in September 2008, employees of Lehman Brothers carrying cardboard boxes out onto a New York sidewalk while the photographers waited across the street. It is a tidy story. It has villains you can point at and a moral you can teach in a single lesson. It is also dangerously incomplete, and in one crucial respect it is flat out wrong. Subprime lending was not the cause of the crisis. Subprime lending was the product. Somebody had to buy those loans in staggering quantity, at prices that made writing them profitable. And the buyers who mattered, the money market funds and insurance companies and pension trustees and banks on both sides of the Atlantic, were not free to buy whatever they liked. They bought what they were permitted to buy. The crisis did not begin with a bad loan. It began with a good rating. I am not here to tell you that 3 rating agencies sat in a room and destroyed the world economy. They did not act alone, and most of the people inside them were not villains. What I am here to tell you is that the AAA rating was not an opinion about risk. It was a legal permission slip written into American and European rule books over 3 decades, and once that was true, the incentive to manufacture AAA ratings became almost irresistible. Before this is over, you will see a rule signed in November 2001 that let a bank hold the same mortgages against 60% less capital, provided the paperwork had been rearranged first. You will watch one company stamp 30 mortgage securities AAA every business day for a year. You will meet 5 school districts in Wisconsin that borrowed $162 million from a bank in Dublin to buy something they were told would survive 15 Enrons. And you will meet the man who built the model that would have caught all of it, and then watched his own employer decline to switch it on. So, let's go back. Not to 2008, and not even to the housing boom, but to 1975, and a change to an American securities rule that almost nobody outside a law firm bothered to read. Credit ratings began as journalism. John Moody published a manual of industrial securities in 1900, and in 1909 a manual of railroad investments, the first to carry letter grades, and for the next 60 years the agencies sold their opinions to the people taking the risk. Investors paid. If the opinion was bad, investors stopped paying. That was the whole discipline of the business, and it worked reasonably well. Then, in 1975, the Securities and Exchange Commission needed a shortcut. It was writing a rule about how much capital a broker-dealer had to hold against the securities on its books, and it needed some way to separate safe paper from risky paper without hiring an army of analysts to judge each bond. So it borrowed a judgment that already existed. It created a category called the Nationally Recognized Statistical Rating Organization, and it let the ratings issued by those firms determine how much capital a broker had to hold. That sounds like an administrative detail. It was the beginning of everything. Because once one regulator did it, everyone did it. Bank capital rules were written around ratings. Insurance capital charges were written around ratings. American money market funds were restricted to the highest rating tiers. Pension trustees, in their own investment policies, wrote the word AAA into their mandates. Central banks decided which collateral they would accept by rating. The legal scholar Frank Partnoy gave the result its best name. He argued the agencies were no longer selling information. They were selling regulatory licenses. Understand what that means, because the entire rest of this story runs on it. A rating had stopped being advice about whether a bond was likely to default. It had become access to buyers who were legally forbidden or financially penalized from purchasing anything that lacked the stamp. If you could put AAA on a security, you were not offering an opinion to the market. You were unlocking a wall of captive money that had nowhere else to go. And then, on the 29th of November 2001, American regulators made the lock far more valuable. 4 American banking regulators, the Federal Reserve, the Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency, and the Office of Thrift Supervision, finalized what became known as the recourse rule. Before it, a bank holding a slice of a securitization had to hold at least 4% capital against it, and sometimes 8%. After it, a slice rated AAA or AA required 1.6%. An A-rated slice required 4%. A bank could hold a pool of mortgages directly and set aside $4 of capital for every 100. Or it could sell those same mortgages into a trust, buy back the senior slice of the same mortgages, and set aside $1.60. The credit risk had barely moved. The loans were identical. The borrowers were identical. The mortgages had not changed. The paperwork had. That is the machine this video is about, and here is where the story gets strange, because the people operating it were being paid by the people feeding it. Around 1970, the rating agencies changed who paid them. Moody's made the switch in 1970. Standard & Poor's followed 4 years later. The economist Lawrence White, who has studied this closely, notes that the reason has never been established definitively, but the standard account points to two pressures arriving at once. Photocopiers made it easy for one paying buyer to share a rating manual with a dozen firms that had paid nothing. And the collapse of the Penn Central Railroad in 1970, then the largest bankruptcy in American history, reminded every issuer that a rating was worth having. So the agencies began charging the issuers of the bonds instead of the buyers. For 30 years, that conflict of interest mostly slept. It slept because the corporate bond market has thousands of issuers, most of whom come to market rarely, and because an agency that inflated ratings would eventually be caught by the default statistics it published about itself. Reputation really did discipline the business. There is careful evidence for this. Daniel Kovitz and Paul Harrison, economists at the Federal Reserve, examined bond rating changes and concluded in 2003 that reputation incentives dominated conflict of interest incentives. I think that finding was right about the world it studied. Structured finance was a different world. In structured finance, the issuers were not thousands of scattered companies. They were a handful of investment banks coming back to the same three agencies month after month with deals worth hundreds of millions of dollars each. The fees were larger and the relationships were permanent. And the product itself was different in a way that matters enormously. A corporation is a fact you assess. A securitization is a structure you design, and it can be redesigned until it fits. That is the part most people never learn. The bank would bring a proposed structure. The agency would run it through a model and say where the line fell. The bank would move the line, adjust the size of the senior slice, add a little more subordination or a little less, and come back. This was not corruption. It was published methodology working exactly as advertised. But it meant the deal was engineered against the model, and any weakness in the model became a design specification rather than a hazard. And if one agency's model was stubborn, there were two others. The industry had a polite phrase for asking around: ratings shopping. The economists Ephraim Benmelek and Jennifer Dlugosch went looking for its fingerprints. The raw numbers do not show it, because the largest and most complex deals were the ones that carried 3 ratings. But controlling for the characteristics of the deals themselves, securities rated by a single agency were about 6 percentage points more likely to be downgraded than otherwise comparable securities rated by more. So we have a machine that turns paperwork into capital relief, and a scoreboard operated by firms paid by the teams. What we do not yet have is the mathematics that made all of it seem respectable, and that is where the popular account of this crisis goes furthest astray. This was not an obvious fraud that everyone winked at. It was an elegant argument with one fragile assumption buried in the middle of it. Take 100 risky mortgage bonds. Individually, each one might have a 5% chance of defaulting over 5 years. Pool them, and then slice the pool into layers, and pay the layers in order. The top layer gets paid first, the bottom layer absorbs the first losses. Money coming in from the borrowers flows down that structure like water down a set of steps, filling the top before anything reaches the bottom. The top layer only suffers if an extraordinary number of the 100 fail at once. So the top layer, made entirely out of risky loans, can be called safe. There is nothing dishonest about that idea in principle. It is the same logic as insurance. A single house can burn down. 10,000 houses in 10,000 towns do not burn down in the same week. Pool enough independent risks and the aggregate becomes predictable, even though each piece is not. Everything depends on that phrase at once. It depends on correlation, on the probability that mortgages in Nevada and Florida and Ohio go bad together rather than separately. And correlation was the number nobody could observe directly, because there had not been a nationwide American house price collapse in living memory to measure it against. A financial mathematician named David Lee published a paper in 2000 offering an elegant shortcut for this problem, borrowing a technique from actuarial science called a copula. His subject was corporate credit. It let you estimate the tendency of borrowers to default together from market prices rather than from default history. It spread through the industry with remarkable speed, and by the time it was famous, it was already being used far beyond anything its author had claimed for it. John Koval, Jakob Jurek, and Eric Stafford put the fragility in numbers in a paper that ought to be required reading. Take their example pool. 100 junk-rated bonds, each with a 5% chance of default over 5 years, half the money recovered when one fails, and a modest correlation between them. Run the structure, and the senior tranche, nearly 9/10 of the whole deal, earns a AAA. Now change one input. Raise the default probability from 5% to 10. That AAA tranche is no longer AAA. It is A+, and that is the forgiving version. Take the leftover middle slices of many such deals, pool them again, and slice them again, which is precisely what the CDO market did, and the fragility compounds. In that second generation structure, nudging the default assumption up by 2.5 percentage points, from 5% to 7.5, is enough to take a tranche rated AAA down to BBB-. Push it to 10%, and the tranche loses roughly half of what it was expected to pay. These are not exotic errors. This is what happens when a modest assumption turns out to be modestly wrong. Koval, Jurek, and Stafford also recorded the fact that should have stopped the market in its tracks. By the middle of 2007, roughly 60% of all global structured products carried a AAA rating. Among corporate issuers, the figure was less than 1%. Read those two numbers together. In the real economy, where AAA means Johnson & Johnson, fewer than one company in 100 qualified. In the engineered economy, it was the majority of everything issued. The safest rating in finance had become the most common product on the shelf. There is a document in the public record that almost no account of this crisis mentions. It is the most damning thing I found, and it was written by a man with no reason to lie about it. Frank Rader was a managing director at Standard & Poor's. From 1995 to 2005, he ran the residential mortgage rating group. He was not a junior analyst with a grievance. He was the head of the department that decided what American mortgage bonds were worth. In testimony to the United States Senate, Rader laid out the history of his own model. The 1996 version had been built on roughly 250,000 loans, replacing a rules-based approach with real statistical analysis. The version that followed in 2002 and 2003 used around 650,000 loans. Then, in early 2004, his group completed work on a far larger dataset, some 2.8 million loans, and that analysis suggested the model then in use was underestimating the risk of Alt-A and subprime mortgages. This is the moment. Somebody inside the ratings machine, using the machine's own data, found that the machine was too generous about exactly the loans that were about to flood the market. The upgrade was postponed. Rader's account is that there were not enough staff and not enough information technology resources to deploy it. Adjustments were finally made in March 2005. The enhanced version, he told the Senate, was never implemented. And in the same statement, he gave the reason in one sentence that explains more about 2008 than most books do. Revenue in his business had grown roughly tenfold between 1995 and 2005. Staffing had not kept pace. His conclusion, rating production was achieved at the expense of maintaining criteria quality, not fraud, not conspiracy. A queue of deals, a promised turnaround time, and a better model sitting on a shelf because deploying it would have slowed everything down and made the answers worse for the customers. The model that would have said no was never switched on. Now look at the volumes that model was not applied to, because they are genuinely difficult to believe. The Financial Crisis Inquiry Commission, the body Congress created to establish what had happened, found that between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities AAA. In 2006 alone, the commission wrote, Moody's put its AAA stamp on 30 mortgage-related securities every working day. 30 a day. Every day the office was open. For a year. And the business those ratings supported was extraordinarily profitable. Moody's own annual report for 2006 shows total revenue of $2.037 billion, of which $886.7 million came from rating-structured finance. That is roughly 43 cents of every dollar the company earned from the one product line that was expanding fastest. Net income was $753.9 million. The operating margin was 54.3% in 2005 and 61.8% in 2006. Almost all of that increase came from a single item, a one-off gain of $160.6 million on the sale of the company's headquarters building. Margins alone prove nothing. Plenty of honest businesses are profitable. What matters is what the people running this one were saying to each other while it happened. On the 21st of October, 2007, the chief executive of Moody's, Raymond McDaniel, gave a presentation to his own board of directors about competition between the agencies. Unchecked, he told them, competition on this basis can place the entire financial system at risk. He was not describing a hypothetical. In December 2006, in an internal message later released by Congress, an analyst at Standard & Poor's had written that the rating agencies were continuing to create an even bigger monster, the CDO market. Then came the rest of the sentence. Let's hope we are all wealthy and retired by the time this house of cards falters. 4 months after that message, Shannon Mooney typed the line about the cows. The two analysts in that exchange, Rahul Dalip Shah and Shannon Mooney, were not cynics who had wandered into the wrong industry. They were doing the job as the job existed. We rate every deal. That is the part of the sentence people forget, and it is the part that matters. Because it is not a joke about one bad security. It is a description of a policy. Now, here is the part of the story that turns a scandal into a catastrophe. And it is the part that gets left out of almost every documentary on this subject. When those ratings failed, they did not fail like a bad stock tip. They failed like a legal instrument. Remember the foundation we laid earlier. AAA was written into capital rules, money market fund restrictions, insurance charges, and pension mandates. So a downgrade was not merely an embarrassment. A downgrade was an event that forced action. Funds that were only permitted to hold top-tier paper had to sell. Banks whose capital charge on a security jumped when its rating fell had to sell or raise capital they could not raise. Lenders who had accepted the paper as collateral demanded more of it or refused it altogether. And the downgrades, when they came, were not gentle. Ben Malek and Dlugosch counted them. In 2007, there were more than 8,000 downgrades of structured finance tranches, with an average severity of about 4.7 notches. In the first 3 quarters of 2008, there were nearly 37,000, averaging around 5.6 notches. More than 11,000 of those actions, roughly a third, hit securities that had been rated AAA. For comparison, in the corporate recession of 2001 and 2002, when about 30% of corporate bonds were downgraded, the average downgrade was 1.8 notches. The first institutions to break were not American. In the summer of 2007, 2 German banks had to be rescued because of positions in highly rated American mortgage paper. IKB Deutsche Industrie Bank at the end of July, and Saxon LB, which was sold to a larger German bank in August. Neither of them had originated a single subprime loan in Ohio. They had bought the letter. That is the difference between a market correcting and a market discovering that its measuring instrument was broken. A corporate downgrade moves a bond a notch or two. These securities fell 5 and 6 notches at a time, from the top of the scale into junk, in a matter of months. The Commission's verdict on the agencies was blunt. It called them essential cogs in the wheel of financial destruction. And the rating scale did not only sit under the securities, it sat under the companies that had insured them, which is how a single letter grade brought down the largest insurer in the world. American International Group had a division called AIG, Financial Products, headquartered in Wilton, Connecticut, and run largely out of London, and that division had sold credit protection on the senior slices of these structures. By the end of 2007, its credit default swap book had a notional value of $527 billion, of which about $78 billion sat on multi-sector collateralized debt obligations. The tranches it was insuring had been rated AAA when they were issued. That was the reason the exposure looked acceptable. AIG itself had been rated AAA by all 3 agencies until 2005. That mattered enormously, because a AAA counterparty can promise to pay without posting much collateral up front. The contracts, however, contained rating triggers. If AIG were downgraded, it would have to post more. By the end of June 2008, its counterparties had demanded roughly $15.8 billion of collateral. By the 12th of September, the demands were over $23 billion. Then, on the 15th of September 2008, the same day Lehman Brothers filed for bankruptcy, all 3 agencies cut AIG into the A range. The calls jumped to about $32 billion, against which it was short by more than $12 billion. The total public support eventually committed to AIG reached $182.3 billion. A downgrade did not describe that crisis. A downgrade caused it. Now, the argument about what all of this means, because there is a real scholarly disagreement here, and it deserves to be presented properly rather than flattened. The Financial Crisis Inquiry Commission's majority, chaired by Phil Angelides, concluded that the crisis was avoidable and blamed a failure of regulation, of corporate governance, and of risk management, with the rating agencies as a central mechanism. 3 Republican members dissented, arguing that the majority had produced a list of everything that went wrong rather than an explanation. The essential story, in their account, was a global credit bubble and a housing bubble that inflated in many countries at once, several of which had no American subprime market at all. That objection has force. Spain and Ireland managed catastrophic housing collapses without any help from Wall Street's rating machine. A 4th commissioner, Peter Wallison, dissented alone and further, arguing that American government housing policy, working through Fannie Mae and Freddie Mac, was the primary cause. That view has serious defenders, and it should not be dismissed as politics. But it sits uncomfortably with the fact that the worst performing loans and the entire AAA alchemy examined in this video ran through private label securitization outside the government-sponsored channel, and that the loss is concentrated there first. Then there are the accounts that are less about blame and more about mechanism. Gary Gorton argued that what happened in 2007 and 2008 was a bank run, but a run on short-term wholesale funding rather than on retail deposits. On his account, the collateral had been deliberately designed so that nobody would ever need to ask what was inside it, and that design was what allowed the system to function at all. The run came when people asked. Once the question was live, the funding vanished. Atif Mian and Amir Sufi, working from Household Data, argued that the fundamental driver was an expansion of credit supply into the weakest borrowers, and that the debt overhang left behind explains the depth of the recession better than banking panic alone. Notice that none of these scholars dispute the underlying facts of this story. The recourse rule was signed in November 2001. Ratings were embedded in regulation. 60% of structured products carried the top rating. 30 a day were stamped in 2006. 83% of the mortgage securities rated AAA that year were later downgraded. The disagreement is about how much weight to put on each link, not about whether the links existed. Now, let me bring all of these threads together, because the chain runs from an administrative shortcut in 1975 to a Wisconsin school board meeting in 2010. A regulator borrowed a private opinion to save itself the work of judging risk, and in doing so turned 3 companies into gatekeepers of who could buy what. A business model change made the issuers of securities the customers of the referees, a conflict that stayed harmless for 30 years and then met a product that could be redesigned until it passed. A capital rule made the top rating worth roughly 60% less capital than the identical loans held directly, which meant the demand for AAA paper was not a preference. It was arithmetic. A modeling assumption about how often mortgages default together turned out to be modestly wrong, and modest errors in that assumption destroy senior tranches rather than dent them. A better model existed at Standard & Poor's by 2004 and was never deployed in a business whose revenues had grown tenfold while its staffing had not. A volume machine then stamped AAA on tens of thousands of securities, 30 a business day at one agency in a single year, while its own chief executive warned the board that unchecked competition could put the whole financial system at risk. And when the assumption failed, the downgrades were not opinions. They were legal triggers, forcing sales into a market where everyone had been permitted to hold the same thing for the same reason. Any one of these, on its own, produces losses. Together, they produced a mechanism in which the safest asset class in the world had to be sold by everybody simultaneously. Here's what that machinery did to people who never bought a mortgage bond in their life. Between June and December 2006, 5 Wisconsin school districts, Kenosha, Kimberly, Waukesha, West Allis, and West Milwaukee, and Whitefish Bay, invested $200 million in credit-linked notes tied to synthetic collateralized debt obligations. The districts were not wealthy institutions gambling with spare cash. They were trying to fund retirement health benefits for their teachers. Of that $200 million, $37.3 million was their own money. The remaining $162.7 million was borrowed from DEPFA Bank, an institution headquartered in Dublin. 5 school districts in Wisconsin, a lender in Ireland, a synthetic structure referencing corporations all over the world. That chain existed because a rating scale said the top of it was safe. According to the Securities and Exchange Commission, which later brought fraud charges against the brokerage that sold the deals and the executive who ran them, the districts were told the investments were so safe that it would take 15 Enrons for them to fail. They were told that 30 of the 105 companies in the portfolio would have to default. They were told that 100 of the world's largest 800 companies would have to collapse before their principal was at risk. The investments declined through 2007 and 2008 as the underlying portfolios were downgraded. By 2010, 2 of the 3 transactions were a complete loss, the lenders having seized the assets in the trusts. The districts, having borrowed to buy them, were then downgraded themselves for their inability to put up more money. They did eventually get most of it back, through settlements that took until 2016 to arrive. That is the ending the story deserves and rarely gets. It is also 6 years of school budgets that had to be written in the meantime. Widen the lens and the numbers stop being comprehensible. The United States Treasury's own accounting of the crisis puts the loss of household wealth at $19.2 trillion and the jobs lost at 8.8 million. Those are not the sins of one industry, but they are the consequence of a system in which the definition of safety had been outsourced, and the outsourcing had been paid for by the people who needed the answer to come out a particular way. The reckoning, such as it was, arrived slowly and in cash. In February 2015, Standard & Poor's agreed to pay $1.375 billion to the United States Department of Justice and a group of states over its pre-crisis ratings. In January 2017, Moody's agreed to pay $864 million. No executive of either firm went to prison. The Dodd-Frank Act of 2010 had already instructed every federal agency to strip references to credit ratings out of its regulations and find another way to measure creditworthiness. That turned out to be far harder in practice than it sounded in statute, for the simple reason that nobody had a better shortcut. And this is where the story stops being about 2008. The specific instrument has changed. The structure has not. In May 2026, the Financial Stability Board published an assessment of private credit, the fast-growing market in which investment funds rather than banks lend directly to companies. It estimated the market at between $1.5 and $2 trillion at the end of 2024. It noted that borrowers in it carry leverage of roughly 5 to 6 times earnings, against about 4 times in the public leverage loan market, and closer to 7 when you adjust for optimistic accounting. It observed that around a tenth of middle market borrowers in one segment did not generate enough cash to cover their interest payments. And then it raised something that should sound familiar by now. Private credit ratings, the board noted, are sometimes provided by smaller and lesser-known agencies and are used to attract insurance company money. Separately, it observed that rating agencies apply what it called a lighter touch assessment to the private credit estimates typically used in rating structured products. I am not predicting a repeat, and nobody should. Private credit is not subprime, the exposures sit in different places, and the regulatory perimeter is different, but the shape of the incentive is identical. Somebody needs a rating in order to sell something. Somebody else gets paid to provide it. And a great many institutions will make decisions based on a letter rather than on the loan file underneath it, because reading the loan file is expensive and the letter is free. The next time someone tells you that the 2008 financial crisis was caused by greedy bankers and reckless borrowers, you will know what is missing from that sentence. Greed is a constant. It was a constant in 1996 too, when the same banks made the same profits without blowing up the world. What changed was not human nature. What changed was that a private opinion had been given the force of law, sold to the party it judged, applied by a model its own author's employer declined to update, and stamped on tens of thousands of securities at a rate of 30 a business day. The crisis was not an accident of character. It was the predictable output of a scoring system, and the scoring system was chosen. That is the story underneath the story you were told. Not a morality tale about appetite, but an engineering account of how a measurement gets captured by the thing it is supposed to measure. Greed explains why people pushed on the machine. It does not explain why the machine moved. Every part of this story was legal when it happened. That is the uncomfortable part. Nobody had to break a rule because the rules were the mechanism. If this is the kind of history you want more of, subscribe. This channel reads the ledgers underneath the stories you were told, and there are a great many ledgers left. And tell me in the comments which link in this chain you think mattered most. The 1975 decision to write private ratings into public rules, the capital rule of 2001 that made the top rating worth 60% less capital, the model at Standard & Poor's that was finished and never used, or the 30 AAA stamps a day. I read every single one. If you got something out of this, a like helps this video reach people who were only ever told that it was all about greed.